Okay, so let's talk about gold because what happened in 2025 was, well, it was pretty extraordinary. Gold didn't just have a good run, it completely tore up the old rulebook. And now, looking ahead to 2026, the real conversation isn't just how high will it go, it's about this massive, fundamental reset in how the entire world is starting to value this ancient metal. So let's dig into why this isn't just another price spike, it's a signal that something much, much bigger is going on. First things first, let's just look at the headline number. I mean, wow. In 2025, gold didn't just climb, it absolutely rocketed past $4,000 an ounce. We're talking more than 50 new all-time highs. That's not just a rally, that's a statement. But the price itself, as crazy as it is, isn't even the most interesting part of the story. The real question is why? What's behind it? And that right there gets us to the absolute heart of this whole thing. Look, what we're seeing, what we're all witnessing, it's not some temporary blip on the chart. This is a structural rebasing. Think of it like a building getting a whole new foundation. The world is fundamentally reevaluating what gold is actually worth in the grand scheme of things. So, what's causing this earthquake? Well, it all starts with the first piece of the puzzle. It really all boils down to one simple but kind of scary idea: a growing distrust in our money. The dollars and euros in our pockets. The value of these traditional currencies is under pressure like never before. And that's forcing investors everywhere to look for a safe harbor, which has given rise to this really powerful new strategy. And that strategy is called the debasement trade. It sounds complicated, but it's not. Put simply, it's a defensive play. It's about protecting your wealth when it feels like the value of your currency is being, well, eroded by massive government debt and endless money printing. And when it comes to that trade, gold is the undisputed king. What you're seeing here is a total 180-degree paradigm shift in thinking. For decades, the old belief right there on the left was simple: high interest rates, bad for gold. End of story. But that's old school thinking. The new reality, on the right, is that gold's biggest enemy isn't interest rates anymore. It's a fundamental lack of trust in the currency itself. It's moved way beyond being just a hedge against inflation. Now it's a hedge against fiscal, well, irresponsibility. And right now, the US dollar is sailing straight into what you could only call a perfect storm. You've got the Fed cutting rates, you've got these growing, nagging concerns about America's enormous pile of debt just getting bigger and bigger. Forecasts are pointing to the dollar index, that's the DXY, which measures its strength, potentially falling to a multi-year low. Then you throw in some political uncertainty with Fed Chair Jerome Powell's term ending in May 2026, and bam, you've got this potent cocktail of reasons for investors to run for safety. But here's the thing. It's not just regular investors losing faith in the dollar. The second major force here, the one that's really reshaping the gold market, is coming from the biggest players in the game, the world's central banks. And believe me, their actions have completely changed everything. So, who exactly are these new power players pulling the strings in the gold market? If you're picturing some Wall Street hedge fund guru or a rogue billionaire, you've got to think bigger, much bigger. The answer is the very institutions that manage the wealth of entire nations. I mean, just look at the sheer scale of this change. It's staggering. Before 2022, central banks were buying, on average, about 450 tons of gold a year. Okay, a lot, but manageable. Since 2022, that number has more than doubled to over 1,000 tons every single year. This is not a blip, people. This is a sustained, structural shift in global strategy. This means central banks have completely changed their role in the market. They used to be what we call price takers. Basically, they bought gold at whatever the market price was. But now, their buying is so huge, so consistent, that they've actually become price setters. They're essentially creating a powerful, solid floor under the gold price because every time it dips, they're right there, ready to buy. And let's be clear, they are not doing this to make a quick buck. This is not about short-term profit. This is about long-term survival. First, they're de-dollarizing, right? Reducing their dependence on the US dollar. Second, they're building a geopolitical shield. They all saw what happened when Russia's dollar reserves got frozen. And third, and this is so crucial, physical gold held in a vault has zero counterparty risk. It's an asset that isn't somebody else's debt. Okay, on to our third major driver. So we've got the trust problem, we've got the central banks, but there's an even larger pool of money out there that has barely even dipped a toe into gold. And I'm talking about private and institutional investors. The potential here is just staggering. Seriously, take a look at this chart. It's kind of mind-blowing. Even with these record high prices, gold ETFs make up this teeny tiny slice of US personal portfolios, just 0.17%. In Wall Street terms, gold is still massively underowned by the average person. This just shows you the enormous runway for growth if and when regular people start to shift their thinking. So this brings up a really fascinating thought experiment. The US bond market is an absolute behemoth. We're talking a colossal $57 trillion. Now, what do you think would happen if investors, getting more and more worried about government debt, decided to move just a tiny fraction of that, let's say just 1%, into the perceived safety of gold? Well, the number is almost hard to wrap your head around. A 1% shift would unleash $570 billion of new demand into the gold market. An inflow of cash that huge could literally send prices into an entirely new stratosphere. So, with that in mind, what does the future actually hold? All right, so this brings us to the 2026 playbook. Let's take a peek at what the big dogs on Wall Street are forecasting, but let's also be real and look at the potential risks that could throw a wrench in the works. And the consensus is, well, it's overwhelmingly bullish. I mean, look at these numbers. JP Morgan is looking at over $5,000 an ounce, pointing to that central bank buying we talked about. Bank of America also sees $5,000, but they're focused on a U.S. fiscal crisis. Goldman Sachs, they're pointing to that private money rotating out of bonds. You can see the theme here. The whole street seems to be aligned on the direction, even if they quibble over the exact number. But hey, let's be balanced. This rally is not a sure thing, and it's not without its risks. A surprisingly hawkish Fed jacking up interest rates could definitely create some headwinds for gold. A sudden outbreak of peace, a resolution to some big geopolitical conflicts, could take the war premium out of the price. And here's a wild card. What if there's a massive productivity boom from AI that strengthens the dollar and pulls a ton of money back into stocks? It's something to keep an eye on. Okay, so we've weighed the drivers, the forecasts, the risks. What's the big takeaway here? What does this all really mean for how we should be thinking about gold heading into 2026? Ultimately, what's happening is that gold's role in the world is evolving. It's shifting. It's no longer just another commodity you trade, and it's not just a simple hedge against inflation anymore. In the world of 2026, it's becoming something more, something like an essential strategic anchor, a foundational asset that's designed to give you stability when everything else feels volatile and uncertain. And all of this leaves us with one final and, I think, pretty powerful thought. In an era where trust in traditional government-backed money seems to be eroding day by day, we have to ask ourselves a fundamental question. What is the true value of an asset that exists completely outside of that system? An asset that is beholden to no single nation, no central bank, and no political promise. That, right there, is the question gold is forcing every single one of us to answer in 2026.